Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. Now, we have Michael today, but not John. We're here, and John's a little under the weather, so we wish him well.
Yes, feeling a little bit congested today. He's, I think, got a post-Thanksgiving Day cold, but I think we'll be well-equipped to talk to our guest today. So,
all right,
looking forward to it.
Who do we have, Michael?
So we have Vanessa Wallace Clunies today from Tax Method Experts. Vanessa, how are you?
I'm doing great. How are you?
Doing good. Thanks so much for being a part of the show today.
Thanks for having me. I'm very excited.
Yeah, we've been looking forward to this podcast for quite a while. I know that my father was disappointed he couldn't hop on here to talk to you, but why don't you start off, if you can, give a little bit of your background, your firm's background, and then we'll get into a little bit of what we're going to talk about today.
Of course. Well, my background, I have been working with my father for about 10 years. My father is Eric P. Wallace, CPA. We have been doing tax method changes since about 2015. We specialize in method changes for contractors, for real estate professionals, tangible property tax methods. We focus on cost segregation, the tangible property regulations implementation, especially. So that is what we do.
A family business like myself. So how do you like working with your father?
You know, when we first started, it took a lot of trial and error, but we are thick as thieves. We
Awesome.
are best buddies here.
Yeah, no, you guys really do work well together from the conversations we've had. So that's great. Yeah. So thanks so much for that. So you alluded to what you guys do in tax method changes, and this is an area that we pretty almost routinely see our clients and a lot of other peers that we work with not really aware of sort of what this is. So could you take a moment and really describe what the tax methods changes might be for your firm and how they might apply?
Yeah, of course. So there are 3 different tiers of tax methods. I'm going to focus on the first 2, but they're primarily changes in accounting methods. So in depreciation schedule specifically is what we focus on. We supply cost segregation studies for property owners, individuals that own commercial or residential property, as well as the implementation of the tangible property regulations. And that is analyzing a building that has been in service and their depreciation schedule for improperly classified assets. So we will file a Form 3115. We will scrub that depreciation schedule, eliminate the unnecessary assets, and help provide a taxpayer some deductions. For cost segregation, we help provide accelerated depreciation on the 5 and 15-year components.
So cost segregation is something we've covered probably at least once for sure on the podcast. Can you walk through what that is, maybe some history surrounding that? I think a lot of our real estate investor clients have probably come across that at some point, but I think for some of the other listeners, that might be helpful to, if you can, walk through, what that is, why it's important to a real estate investor to consider.
Yeah, of course. So cost segregation is taking a building that is either classified as 27.5 for a residential property or 39-year for a commercial property, and dissecting it into components to help provide accelerated depreciation. So we will look at the building component as a whole, and we will analyze any 5-year components. For instance, hardwood floors could be considered 5-year components, cabinets, and we break them out in an engineering study that is factual and evidence-based, and we provide details. We will also break out the 15-year components, which typically is land improvements. But if you have a commercial property, you can also take 15-year components as qualified improvements that you've done on the property, and that will also be 15 years. We do this so that the taxpayer has a benefit of accelerating the depreciation rather than taking the building as a whole over that 27.5 or 39 years. we provide that accelerated depreciation for the 5 and 15-year property. Now, this is so great because per the tax code, there are years that a taxpayer or a building owner could take 100% bonus depreciation on that 5 and 15-year property. So, for instance, if they place that property into service in 2021, those 5 and 15-year components qualify for 100% bonus depreciation, excuse me. That means they can take that entire amount of that 5 and 15-year property as an added accelerated depreciation to help offset their taxes.
That's great. Now, who does this apply to? Is it every real estate investor? Is it certain ones? What are the criteria that you would look to and your firm would look to in terms of like who can explore this type of option for cost segregation?
Anybody that owns a property or leases a property. If you have residential property, we recommend that you're a real estate professional in order to utilize the complete accelerated depreciation. There are passive rules that if you do not qualify as a real estate professional, you won't be able to utilize the 100%. You will have to abide by the passive income rules. But if you are a real estate professional or you own an Airbnb and it is considered a commercial property, you can fully utilize cost segregation. So we recommend anybody that has a property that they utilize cost segregation in order to help offset their income, especially if they're making money.
That's excellent. Now, you mentioned the tangible property regulations, and this is, I think, the area that at least I know our firm was really excited to start working with yours, in that this is an area that, from your experience, and you were great in educating us on this, a lot of real estate investors and taxpayers not really aware of these regulations. Can you walk through what they are, how they work, and maybe some use cases or case studies on how they would apply or I guess didn't apply?
Yeah, so the history of the tangible property regulations. These regulations came out in 2013, and they state that you must analyze any work expenditure provided on a building after the building was placed into service and determine if it should be repairs and maintenance or if it needs to be a capitalizable event. The IRS took 60 years to publish these regulations, so they're not an easy task. There are 16 RABI rules, what we call the restoration, adaptation, betterment, and improvement rules, that you have to analyze your expenditure compared to the component, the building as a whole, and determine if that work expenditure needs to be capitalized or if it is actually a repair and maintenance. This is a yearly event that you have to go ahead and employ. Most CPAs unfortunately don't understand it. Like I said, it came out in 2013. It took 60 years for the IRS to publish them. They're not easy to understand. It would take a CPA roughly 500 to 800 hours just to get the basic understanding on how to apply it somewhat properly for a taxpayer. We would say that probably about 80% of individuals that own properties are not in compliance with the tangible property regulations. And unfortunately, for most people that are not in compliance, this is a mandatory IRS regulation. This is not optional. Where cost segregation is a commodity, it is optional. If you choose to employ it in the year that you purchase the building, then you can do so. If you choose to hold off and do it 10 years down the road, you can do so. The tangible property regulations must be employed with the IRS. It's a huge thing, and if the IRS would determine that an individual is not complying with the tangible property regulations and the taxpayer falls under audit, they're at risk for losing the depreciable value and the net remaining depreciable life on any asset the IRS deems improperly classified, which is massive.
Yeah, no, that's huge. And so, can you walk through, Vanessa, I guess maybe a case study, just to give our listeners maybe an idea of maybe a property owner that you worked with and how these regulations were applied, and some of the investigative work that your firm did up front to really uncover, really from the tangible property perspective, like you said, non-compliance with these regulations, that's a big deal. So if you wouldn't mind walking through that, that'd be great.
I'm going to pick a big example just for the wow factor for the current time.
Yeah.
There was a boutique hotel in New York City that we were engaged with in order to do the tangible property regulations. The building had been owned by the property owner since probably about 2000. They had done significant repairs and maintenance to the property over the life of the taxpayer's ownership, excuse me. And that is important because if you do any repairs and maintenance after about 5 years after the property is placed into service, that's when you generally have the best advantage for utilizing the tangible property regulations. But we went in, they had done significant repairs and maintenance, renovations to their rooms. They went from a standard New York City hotel to a very nice boutique hotel. They took it in stages, but we went in and we analyzed any expenditure that they did, and we determined if they should be capitalized or not. For instance, they did a hotel and lobby renovation for about $3 million. It's not a significant portion of the building. Yeah, you see it whenever you walk in and you could be wowed by the property, but the percentage of the building as a whole, it was roughly about 5%. And under the tangible property regulations and the RABI rules, it does not meet the criteria of a capitalizable event because the percentage of the building as a whole was so immaterial, essentially. But this taxpayer, we saved them $19 million in deductions for improperly classified assets that were on their depreciation schedule.
Yeah, I mean that's just huge. And now I know you guys don't do tax compliance work typically. Your firm is more of a specialist that works alongside the CPA firms, correct? Can you
Yes.
walk through a little bit about your relationship with the tax professionals and in terms of how they might view your services?
Absolutely. We are highly trained specialists. We specialize in the tangible property regulations and other method changes. We come as an enhancement to the CPAs. We will assist them, and actually we just handle it ourselves, but we will work in tangent with them. We will analyze any expenditure on the depreciation schedule, provide our detailed analysis as to why we determined if it should be a capitalizable event or if it needs to be repairs and maintenance. We will also complete the Form 3115s, all attachments, necessary attachments for the form, this 41A schedule, which helps provide the CPA that adjustment to correct their depreciation schedule. And we will also, like I said, provide our detailed analysis for the CPAs and for the clients to hold indefinitely for at least 5 years. We work with the CPAs. We are not here to take anybody's client. Matter of fact, we don't really want any more 1040s or 1120s. But we are just here to assist in any way that we can to provide the taxpayer an additional benefit to offset their income. We will file the 3115s. We will tell the CPAs how to file the 3115s properly, and that's it. We come in as like the icing on a cupcake, essentially.
Yeah, no, that's what we love about all the professionals that we work with is that it's a team effort, right? We
Absolutely.
all, you don't know what you don't know. It's one of our favorite sayings. We don't know everything. Oftentimes the tax team, again, specialized training that they might have to go through in order to understand this very specific set of the tax code. It's great to partner with a firm like yours so that we can all better help the client. That's really what is most important at the end of the day. So I love that process that you guys go through to help with that. Now, another question I have, Vanessa, am I correct in saying that if, let's say a client goes through or taxpayer goes through your process, you're able to uncover, well, let's use that hotel owner that you had, $19 million in deductions that they weren't currently taking advantage of. What does that do to their tax basis of that building? Does that reduce the tax basis of their building? And what strategies can you think about to work with that or to address that issue? Maybe if there's ever a sale in the future of that building, does that increase the tax exposure or capital gain exposure on that sale?
Absolutely not. So what we do when we look at a depreciation schedule, we analyze for improperly classified assets. Once we find those assets, we eliminate them from the depreciation schedule with the Form 3115 because they should not have been capitalized in the first place.
Okay.
This is significant for taxpayers because it significantly reduces their recapture. There is no recapture. These are a deduction, and they are no longer on the depreciation schedule. So it will essentially change the basis as a whole, but the building itself will not, the basis, the original purchase building itself will not change.
That's really key, because that is something that, when we have presented this idea and these regulations to some of our clients, that has been, I won't even use the term pushback, but that's been a question that's certainly come up is, maybe I don't want to necessarily reduce the tax basis substantially so that when I exit, I have to pay more capital gain tax. We know there are things you do 1031 exchanges, perhaps if it's a commercial property and things like that, to maybe defer that. But I love that response. And also, particularly for the tangible property, I mean, these are mandatory regulations, right? So
they are absolutely mandatory regulations. And now with cost segregation, it will adjust the basis of the building slightly. And what I mean by that is it's going to adjust the basis for the significant portion, the 27.5 or 39-year property. The building as a whole is still going to remain the original basis amount. You're going to have the 5-year, the 15-year, and the 27.5 or 39-year property. But as a whole, we don't eliminate anything of the building unless we do a partial asset disposition with cost segregation. That's if an individual purchased a building, did significant repairs and maintenance to it within the first year of purchase before placing it into service, then we would dispose of a portion of the building. But tangible property regulations, it's not adjusting the building basis itself, just the assets that follow it for all repairs and maintenance and work expenditures after the building was placed into service. So I just wanted to make that clarification.
Yeah, no, that's great. That's great. And just to reiterate the timing of this, because this has also come up in some of our conversations. You alluded to this a little bit earlier. From a timing perspective, if somebody is interested in working with you, when is the best time, I guess, or most optimal time to be looking at either of these method changes for their properties that they may own?
For cost segregation, like I said, it's a commodity. Whenever the taxpayer would like that added benefit of the accelerated depreciation, they can take it. If they have income that they need to offset in year 2024, we can do it now. If they don't have anything until next year or the following year, we can do a cost segregation then. Typically, the best time to do a cost segregation is when the building is purchased and or built or within 5 years. The tangible property regulations, the building must be in service for at least 5 years in order for us to employ the tangible property regulations. And that is because we need to analyze the building as a whole and the factors surrounding the building. For instance, you painted the building, you spent about $20,000 painting a building. Did that paint deteriorate during your ownership? Did you not like the color and you just wanted to change it for cosmetic reasons? Those are factors that we will look at and analyze in order to determine if that $20,000 painting expense should be written off as repairs and maintenance or if it needs to be capitalized. More likely than none, it's going to be repair and maintenance, especially if it's a cosmetic paint. It does nothing to the structure, does not benefit the building, does not better the building, does not improve the building, does not restore the building. It is generally just paint.
Right. Just paint. Yes.
Yes.
Now, how long would a study typically take if a client engaged with you to perform your services? How long is the typical engagement?
Cost segregation, if we have all of the information in, we can provide a cost segregation study within 3 weeks. Tangible property regulations, it depends on the magnitude of the work. We had an individual that owns significant amounts of malls throughout the United States. That took us a little bit of time going through each mall, analyzing any expenditure done on the mall, on their depreciation schedules, and determining if it was repairs and maintenance. That took us about a couple of months in order to do that. Typically, if we have all the information, we'd like to get these done within 2 months. But if you need the benefit for tax year 2024, it does not need to be done by year end 2024. It needs to be completed by the time you file your tax return. So if it's an individual filing timely, that could be March 15th or it could be April 15th. If they extend, then we have until October and September to handle these method changes for them.
Yeah, I'm glad you brought that up. That was going to be a next question. If there's a listener out there that says, "Hey, this is great. When do I need to get started on that in order to maximize the benefit?" So I'm glad that you asked that. Vanessa, how do you work with a client from a compensation standpoint? Is it a flat fee that you work with? Can you outline a little bit about how you work with a client in that way?
Absolutely. For cost segregation, it is a flat fee. It is a service. So we provide, for a building a certain size, I will just quote it, it will be competitive compared to other cost segregation services. For our tangible property regulation work, it is a percentage based off of the TPR deduction or the 481A deduction that the taxpayer gets. And that typically ranges from 5 to 9%. And that is because that is based on our time, our work that we provide into all of the analyzing of each expenditure, as well as collecting the data, providing the forms and everything. But that is a percentage-based fee, not a fixed fee.
Yeah, which is very common and
Mm-hmm.
never, in my experience, seen that as being any sort of hurdle. If you're going to be able to get the taxpayer in compliance, get some additional deductions and tax savings, that's a very fair fee. Vanessa, are there any other questions that I should be asking you with regard to your services? Anything that you may want to educate our listeners on about what you guys do? Maybe some things that they should be thinking about if they're a real estate owner?
Absolutely. One thing that I find most common when it comes to CPAs and when a client brings this up to their CPA typically says, "Oh yeah, we do that." And I just want to provide a little word of caution here. Typically, whenever they are talking about employing the tangible property regulations, they are talking about being in electing the de minimis safe harbor rule, which is from the IRS, any expenditure $2,500 and below is automatically an expense. A taxpayer can determine that a price for them is going to be different. For instance, we have a client whose de minimis safe harbor amount is $15,000 based on the expenditures that they do on their properties on a yearly basis. That is not complying with the tangible property regulations. The tangible property regulations, like I said earlier, are a yearly mandatory event. Any expenditure that you have done in tax year, the current year, so for instance, 2024, must be analyzed if it is a capitalizable event or if it needs to be repairs and maintenance. Doesn't matter how long the building has been into service. Like I said before, if it is 5 years or more, especially so, but you need to determine whether or not it is repairs and maintenance or it needs to be capitalized on the depreciation schedule. And you must provide your evidence as to why, your analysis as to why. If the IRS were to come in and say, how did you determine your 2023 expenditures and why are these not on the depreciation schedule? You must be able to provide the IRS agent that reasoning. So this is a very important fact, and I know that a lot of people said, "Oh, we did tangible property regulations in 2015 when it was mandatory." It's still mandatory. You still must employ it.
Yeah,
And
I didn't mean to cut you off, Vanessa, but
no,
that
that's fine.
brought up another question in terms of a lot of what you do, correct me if I'm wrong, is maybe looking in the past for
Yes.
those that taxpayers that maybe weren't in compliance since 2015. How do you work with the client going forward? Let's say we've done that analysis in the past, but we're still going to own the property. We're still going to be making, maintenance and improvements to the property. How do you work with a client going forward? Is it every year engagement? How does that work?
That is a great question. We have had a client in the past. We did the TPRs for him in 2017, 2018. We filed a Form 3115 DCN, which is designated change number 184, to clean up his depreciation schedules for the assets improperly classified. We from then did yearly analysis on each expenditure that he did for tax year 2019 And in 2020, he decided to go ahead with a different firm. So he went with them, and they, I guess, are going through and they are analyzing all the TPRs. We have been in contact with this individual again, and we have found out that the previous firm that he hired after us was not employing the tangible property regulations properly. So now we have to go back for the past couple of years that we weren't working with him and fix everything that they did. And we could do that with the DCN 184 because it has been more than 5 years since we filed the first Form 3115 DCN 184. And that's important to say because you cannot file a DCN 184 each year. You can only file it every 5 years. So this is why it's important to go through after you file a 3115 DCN 184 to clean up the depreciation schedule for the prior improperly classified assets and employ the tangible property regulations on a yearly basis. Because if you miss it, you cannot do anything to correct it for another 5 years. Does that make sense, Michael?
Yeah, I think so. I mean, well, I think you just reiterated the need for this, to have a specialist involved. I think that just to make sure that you're in compliance. And again, CPA's wonderful job, but there's so many areas of the tax code that they just might not be up to speed on. And this is a very, very specific subset of the tax code. I mean, geez, it takes 60 years to
60
publish
years
regulations. Although I don't know how. I mean, that might be just par for the course these days with
you
the
never
IRS,
know. You never know.
Still is a long time.
Yeah, but we always say too, we're specialists in the tangible property regulations and method changes. We are not specialists in SALT. We are not specialists in international real estate tax. We always stress to anybody who is looking for individuals with a specific need for that is to go to the experts. We will recommend experts, but I'm not going to lie to you and say, yeah, I can handle SALT. Absolutely not. I would never want to put a taxpayer into jeopardy by saying I can do something I can't. And this is what I hope that their CPAs will also do and admit when they're not an expert in something and find the experts that can do that.
Yeah. No, this is great. Well, Vanessa, I think we're running a little low on time, but this has been a fantastic podcast. I think you're going to generate a huge amount of interest.
I hope so.
Thank you again for being a part of it.
Thank you for having me.
And before you go, if you wouldn't mind, if somebody's listening, wants to get in touch with you, how do they do so?
Well, you can send me an email, vanessaw@ericwallacecpa.com. And that's Eric with a C, WALLACE, You can also visit our website, taxmethodexperts.com, or you can get in touch with John and Michael, and they will put you in touch with us.
Excellent. Thank you.
Thank you so much for having me.
How do people get in touch with you if that's the route they want to take?
Sure. So you can reach us on social media. We're on LinkedIn, Facebook. You can reach us on our website, www.cbfgllc.com.
All right. Well, thank you to both of you, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beech Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.